Are electric vehicles going to flood the streets in the next few years? Or are all these EV stocks overvalued and about to come crashing down? Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. I'm Andrew Shear, and in the next few minutes, I'm going to teach you two essential theories about stock valuation, explain two historical examples of stock market bubbles, and discuss what's happening right now with electric vehicle stocks. At the end, I'll put it all together and give you my thoughts on what will happen next. Before we get started, do me a favor and give this video a blue thumbs up. And while you're at it, click that red subscribe button. You're about to learn something new about money. We're all familiar with how the stock market works. You buy shares of a company, and over time those shares can go up or down in value. If they go up in value, you can sell them later for a profit. But if they go down, you're stuck with a loss. The trick is to be able to predict ahead of time which company's stocks will go up in value. Two theories about how to do just that are the firm foundation theory and the castle in the air theory. The firm foundation theory suggests that a share of a company has something called an intrinsic value. That intrinsic value is based on things like the amount of profit that company generates, how much of that profit is distributed to shareholders in the form of dividends, and how much potential that company has to grow in the future. The intrinsic value offers us a way to predict how a stock price will change in the months and years ahead. If the price for a stock is currently less than that stock's intrinsic value, you can expect it to go up in the future. And if the price is currently higher than the intrinsic value, you can expect it to go down. The castle in the air theory suggests that a share of a company is simply worth as much as someone else is willing to pay for it. It's all about predicting how the group of investors that make up the market will behave in the future. If you anticipate that investors as a whole will want to invest in a certain company, then you buy that company's stock. As demand goes up, so do prices. And as long as you got in early and there's someone else willing to buy, you can sell your shares and earn a nice profit. The optimism of the crowd is what drives up the price further and further, building a so-called castle in the air. The problem with the castle in the air theory is that as a company's stock price gets higher and higher, fewer and fewer people will be in the market to buy. And when there aren't any buyers left to hold the castle up, it all comes crashing back down to earth. Way back in the early 1600s, tulips were all the rage in Holland. Although expensive, they were a staple in Dutch gardens. Over time, many tulips became infected with a virus that caused variations in the color of their petals. The oddly colored tulips became very desirable, and as demand went up, so did the prices. It was tulip mania. In a matter of a few years, certain tulip bulbs were selling for the equivalent of thousands of dollars in today's world. Imagine going to your local garden center and dropping $1,500 on a single tulip bulb. People were trading their personal possessions, including land and furniture, in exchange for these bulbs, expecting prices to continue rising. And they did, until 1637, when people started thinking that maybe it would be a good time to sell and get out of the tulip game. Exorbitantly expensive tulip bulbs flooded the market, and without much demand, prices plummeted. The tulip bubble had burst. Fast forward a few centuries to the 1990s. The internet was on the verge of revolutionizing the way we conducted business and lived our lives. People could see the potential for growth and invested their money accordingly. Stocks for internet-based businesses like Amazon and Yahoo went up like a rocket. Venture capital firms invested billions of dollars in internet startups. Even companies that had nothing to do with the internet changed their names to include .com or .net and struck gold. Trading stocks online became enormously popular, and people were glued to the TV watching CNBC. It seemed like the prices would never stop going up. But in the year 2000, they did. Startup companies declared bankruptcy. Companies like Amazon and Yahoo lost more than 90% of their value over the course of just 12 months. And just like that, the dot-com bubble had burst. Now, here we are, 20 years later in the present day. A global pandemic has forced millions of Americans out of work. The desire to trade stocks and earn a living from one's couch is stronger than ever. In the past few years, new apps have made investing easier and more accessible, and commission-free trading is now a reality. Investing and day trading have become trending topics. Successful young investors are out in force on YouTube and TikTok telling you about how much money they're earning and encouraging you to sign up for Webull and get 2 free stocks. And a new technology is emerging that has the potential to once again change the way we do business and live our lives. Of course, I'm talking about electric vehicles. Everything I just described has contributed to the rise in electric vehicle stock prices in the past 12 months. Workhorse, NIO, Blink Charging, Arcimoto, Electromechanica, Xpeng, and everyone's favorite, Tesla. The list goes on and on. Most of these companies aren't profitable. Many of them aren't even selling anything. And yet their stock prices have increased dramatically this past year on the basis of press releases, news articles, and optimistic speculation. It sure sounds like electric vehicle stocks are the new tulips. At this point, I believe it would be wise to stay as far away as possible. And if you've been lucky enough to beat the crowd and get in on the ground floor of this castle, I'd get out now while you still can. Before I wrap up this video, I wanted to take a moment to say thank you. My channel surpassed 1,000 subscribers last week, and I am humbled and truly grateful that so many of you have trusted me to continue delivering the information you need to understand and succeed with money. Thank you from the bottom of my heart for coming along on this journey with me. So what do you think of electric vehicle mania? Let me know in the comments. If you enjoyed this video, then you might enjoy my take on what you need to know before starting a YouTube channel. Click right here to watch. And if you're not already a PPF subscriber, you're totally missing out. Click right here to hop on board. As always, thanks for watching. I'm Andrew Scheer, and I'll see you next time.